Welcome everybody back to the Dwyer Team podcast. This is episode 7. So thanks again for tuning in. So today we are here to talk about some lending ideas and some lending options. Lending in general. It seems to be a big topic of interest, as it should be. So we do have Nathan Degiorgio with us again today. Nathan!
Hello everybody out there in cyberspace.
So thanks for coming today, Nate. So we did put together a few questions for you, Nate, that we thought that we get asked all the time and seem to be the most popular. So we wanted to get your take on some answers here.
Sure. No, before we kind of jump into the questions though, let's take a minute, Nathan, maybe to just tell us about what you do, who you are, what company you're with.
So yeah,
that's probably smart. That's probably good.
Probably good.
Yeah,
idea.
who the heck are you? Why are you here?
Mortgage broker with Mortgage Alliance, with a team at Mortgage Alliance called Y Mortgage. Came up through the bank with lending. Been in the mortgage business about 15 years now, and primarily focus my business in London and area, but can kind of go wherever across Canada as needed in this virtual world that we're in.
I'm actually going to write down a question about that, which I'll talk about later. About
I'd be curious if it differs.
Territories, yeah.
We'll
talk about that later.
Okay.
Talk about that later.
All right.
We'll stay on topic.
So why don't we start, let's dive into what's kind of new right now, which is also what we were just talking about, which is first-time home buyers. Let's talk about what's changed with first-time home buyers as an intro to the lending, because there has been some changes in the mortgage industry just this year.
That are important changes.
Yeah.
So want to talk about it.
So just last week, the government announced that they were making a couple of changes for first-time home buyers, specifically buying new builds with less than 20% down. So CMHC insured mortgages, which means the mortgage purchase price also has to be under $1 million, which can be harder to find in the new build segment. And they're opening up 30-year amortizations for that particular segment of people, which is
just new build 30. Okay.
Just first-time home buyers, just new builds, just less than 20% CMHC insured mortgages. So if you got 20%, you're a repeat home buyer, you're buying for over $1 million, you're not going to get the 30-year amortization.
Now, with this change, do you think that this could be something that they're going to be implementing more, not necessarily just with new builds, but do you think it's the start?
So it could be the start. I mean, if you have 20% down or 20% or more down now, 30 years is available to everybody at the banks. It's just with the CMHC insured, which typically is first-time home buyers, you do have the gear cap to 25 years. So hopefully this is the start of maybe opening things up, and you're going to have repeat home buyers, anybody, and first-time home buyers who are buying not necessarily new, maybe just resale, right? Just to get into the market. So they can look at these condos, townhouses, everything.
So Nathan, you said 30-year amortization is available to everybody.
Correct.
I did not know that.
At 20% down, yeah. So if you have 20% equity, it's a CMHC rule. So the CMHC rules are you have less than 20% down, purchase price has to be less than $1 million, and you're capped at 25-year amortization. But then when you go to 20% down, you can buy more than $1 million, and you can go up to 30 years.
And 20% down, does that have anything to do with your credit rating? What if you have 20% down, but your credit's not stellar?
Well, then you can look at alternative lenders, which cost a little bit more money to borrow from, but they have 30-year, and those alternative lenders, some of them have even 35-year now.
Okay.
So there are longer amortizations available.
Good to know. Okay.
Yes. The key here is you're stimulating they're stimulating new builds because they're making it more appealing for first-time buyers to want to get into that. And then that's hopefully going to flood through the whole market.
When we're talking about it, we understand, we hear 25-year, 30-year amortization with mortgages all the time. But for a first-time home buyer, for example, they might not even know what that difference is. So can you explain the 25-year versus...
Yeah, so if you're buying like up near the top end of that number, so like an $800,000 or $900,000 purchase, you're looking like $300 to $400 a month in savings. So it's significant. It's not like going to completely change the qualification process, but it's going to help. I mean, it's going to help.
It might make new builds.
Yeah, it's $300. $300. It lowers the payment, makes it easier to qualify for a little bit more. So it's definitely something.
Okay. And then what is this about? Now the first time home buyer savings account, that's no longer what they implemented from the government last year, the first-time homebuyer
Yeah.
savings plan. I think they took that away, did they not?
Yeah, they did, but they did do so. RSPs, they've changed RSPs, and so you can now take out up to $60,000 out of your RSPs as opposed to $35,000 it was.
Yeah, it's a pretty
August
big.
1st. And you have so initially when you took money out of your RSPs, you have to pay that money back over 15 years, and you had 2 years after when you purchased the home to start paying it back into your RSP. Now you have 5 years, so you can buy the home and then you don't have to pay any of it back for 5 years, and then the 15-year payback period starts 5 years after you're in your home.
Oh, okay. Yeah, it's interesting too. Like I know I've met quite a few people that didn't even realize they could take from their RSP to purchase. So,
this is like most of the government policies. This is pretty light on kind of details right now. It's probably just
especially when it's this new.
They just want to.
Yeah.
They're trying to get vote. They're trying to get the young vote. It seems like with the budget and everything. Everything is all about getting the young vote. So
yeah, they just need to give the young people houses. That'll give them the vote.
This is part of that. I think. Hopefully the details come because it's coming in August. So we need to get those finer details lined up quickly.
Yeah. But what I'll say too is that if a new build is not for you, we're working with first-time home buyers all the time, and don't let this market discourage you. Sure. There's always options, and that's what we're here for. It's speaking of that, is that everything that covers the first-time home buyer changes with the mortgaging?
That's pretty much everything that came out like last week. Yeah, those were the announcements that were made last week. Yeah.
Okay. Now, should we ask the question that we're all thinking?
Go ahead.
Well, I don't know what you're
Nathan. Oh, we're all thinking this.
Okay. I
Dramatic
guess we'll
effect. When are the rates going down?
Not soon enough.
When are the rates going down, Nathan?
So,
sorry.
That was aggressive.
A little aggressive. Apologize. Passionate.
So, when I would have said last week, probably June would be the first time you see a rate cut, but then inflation data from the U.S. came out. We need to see inflation coming down to the 2% target. Inflation from the U.S. was up, and yesterday Canadian inflation was up from 2.8 to 2.9, which is not earth-shattering, but moving in the wrong direction. So maybe not June, maybe longer. Who knows? Who the heck knows? This year, hopefully this year. I said that last year, hopefully this year, and it didn't happen.
Well, that's the thing. Nobody knows, and we see articles all the time. I'm seeing a lot of people predicting June, July, but
yeah, and it'll be a slow, measured reduction in interest rates. We're not going to see bank prime is at 7.2% right now. It's not going to go down to 5.2 in 6 months. It's going to take.
I figured it'd be like 10 basis points. It would be 5.
Well, it's usually a quarter of 25 basis points, a quarter of a percentage point.
You think they'll see that much of a
It's
change?
what you'll see I would think for the most part they have in the past done smaller than that, but that's what they went up by. They went up by a quarter of a point.
Yeah,
a couple aggressive ones were half a point. I think the reduction when they're lowering, it'll be a quarter of a point a time, and you might see it where they do it, and then the next meeting they don't do anything, and then the next meeting they drop it again. Like they'll do it.
It'll be
slowly,
fall, yeah.
and it's not going down to where it was before, and you're not going to get a 1.7% 5-year fixed rate ever again, probably. So stop what you're thinking with respect to those crazy low rates.
Okay.
The fixed rates right now are actually lower than the variable. So the fixed rates right now are you're looking kind of low 5s for 3-year, 4-year, 5-year fixed. Variable rates you're at probably about 6.5% right now. So there's quite a big spread, and in the wrong direction. Typically the fixed are higher than the variable, but right now the fixed are lower in anticipation of the coming drops.
Yeah,
we think anyways.
So, being that there's such a difference between the fixed and the variable, why would anybody want a variable rate mortgage then?
If your personal forecast is rates are going to go down quicker, and they certainly could, then it could be an option for you. My take on it is go short-term fixed right now.
Yes.
Because if you could be 1.5% lower on a fixed rate, and it's say 3 years, then you're renewing that much earlier.
In 3 years from
in
now.
3 years. I really don't think 3 years from now that variable rate is going to be like, if it's 1.5% higher now, it needs to be 1.5% lower by the end of the 3 years. Is prime going to drop by 3% in 3 years? Possibly, but probably not any faster than that. So that's why for most people I'm recommending the 3-year fix. There are other things to consider, like penalty considerations. Variable rate penalties are typically a lot lighter than fixed rate penalties. So if you think you're maybe gonna sell the house, you're gonna get transferred to the US and you got to sell the house quickly or something in a year or two, then maybe the variable makes more sense because you're not going to get hammered as hard on the penalty.
Well, that's why they have both of the options, right?
Or a rental. I typically say with a rental property, variable rate can make more sense because with a rental, it's not an emotional investment, and so if someone makes you the right offer, you'll sell.
Right.
As opposed to your primary residence,
Correct.
where you have an emotional attachment to it, and you need a home for your family.
Yeah.
With an investment, with an investment property, someone makes you the right offer, and then it's gone because that's what you're in it for.
So maybe we should
Good point.
speak a little bit to what we can expect, like what happens to the market when these interest rates change, and because we're always talking about it and everybody's hearing about it, but unless you're doing what we're doing, it might just be numbers to you.
Yeah. So I mean, we always see. You guys see this too. When rates start to come down, prices start to go up.
And demand goes up.
And demand goes up,
significantly.
and the market
The
gets
buying power is
the buying power is back, but the market gets a little bit crazier and more difficult for buyers. I mean, we're seeing now. You guys can probably speak to this more than I, but people putting home inspections in their offers, people putting condition of financing in their offers. 18 months ago, that wasn't even like on the radar.
Yeah.
So
People are just trying to get in.
I don't know that it's gonna, when rates start to come down, if it's gonna get that crazy again. But those will start to be considerations where you're going in firm and you don't have your financing arranged.
I mean, that wasn't ideal, especially on the buy side.
That's not an
We're working
ideal.
with the buyer. It's very hectic for them because they're.
Well, it's not what we want. We want
that's
our
what I
buyers
mean.
to have all the conditions that they need.
We want them to
feel-
make sure they're protected
Yeah.
and look out for their best interest and make sure that they're comfortable with the purchase and they're in control. And a lot of times when it's rushed like that, when the interest rates were at all-time low, and it was showing buyers properties and then saying, if you like this, there's 7 offers already.
Yeah.
So you're going to be, if you like this, we got to offer on it right now. We got to get back and work on this. And it's not, from a buy perspective, that's not ideal in any instance, whether that's your first purchase or your 50th. Nobody wants to be in that situation. But it was definitely a benefit for the seller because the seller was in control. They could price a property at pretty much whatever, and it would sell with tons of interest in it and sell really quick. But you're right, when you sell in a market like that, you have to buy in a market like that, which can be. It's a
and
pendulum
timing it
that's
appropriately, which is
that's
where we come
one-sided
into.
for sure.
Yeah.
It's not a benefit, I find, for a buyer to be rushed like that. So it's slowed down a little bit. You have a chance to maybe look at something twice or get the home inspection, get your conditions approved that are there to protect you, and that's always better.
Even since January, though, like I see the market just moving so quickly, so constantly. The days on market's changing every week. It's just important to stay on top of it, so you know what's happening. But with these interest rates coming down, I noticed on the news, it was Royal LePage or something I saw. It's just from the news, but they were expecting 9% increase by the end of the year
In what, inventory?
in prices.
9% increase in price.
Across Canada.
I think there's a lot of. I mean, I would not advise my clients to this, and nor would you. But I think a lot of people are just probably people who are not talking to professionals are
They're trying to
are just
figure
on the
it
sideline.
out.
As soon as they hear that the overnight lending rate the Bank of Canada is dropping interest rates, then they're going to flood the market again, right?
Yeah.
And the reality is
because that's
the
their
fixed
answer
rates,
to go.
the fixed rates are already lower. So the reality is that 5% fixed rate. We can talk to Barb about 5% fixed rates. That sounds real. It sounds real good 20 years ago.
Yes, it did. Yes, it did.
Okay, so we're going to take a quick break, but right after we'll be back with more from Nathan Degiorgio.
So how did we get into the affordability crisis that we're into right now?
So it's been building for, I think, over probably the past couple of generations, like a long time. But specifically, I mean, what's happened in Canada was before the 2008 financial crisis, which is
Just watched The Big Short last week.
Somewhat recent memory. We were
Great movie, recommend.
we were not as bad as The Big Short. We were not.
That was US.
No, that was US. Yeah.
We were not lending money to just anybody. They had those.
I was yelling at the TV.
In the US, they called them ninja loans: no income, no job, no assets.
Yeah.
And you just,
they were just giving it to everybody.
Just give it to everybody,
They
right?
weren't approved.
Yes.
Yeah.
Yes, and I remember in The Big Short, there was like strippers that owned like 5 houses and stuff.
That's how Steve Carell figured it out. The other guy was all numbers, but Steve just went to knocked on the door and was like, "What the heck?"
So we never did that, but we had.
Sorry, here's your summary of the movie, guys.
We had 40-year amortizations back then, which we've gone all the way down to 25, so that's almost half the time. And no down, like you didn't need any down. You could basically
the 100%
100% mortgage,
Oh my
100% plus the CMHC insurance premium.
You're
so
like
really,
hurting.
the mortgages. So you're starting out with the mortgage being higher than what you pay for the house because you're paying you're putting the CMHC and premium on top of that. And then the crisis happened, and so then everybody got into the market when that happened. There was a lot of people that owned homes, and maybe some that probably had no business owning homes ended up owning homes.
Is that not why we have the stress test now?
And now, so now they've implemented the stress test.
I'm interested, Barb. Barb's scolding me. I'm going to keep interrupting Nate.
So slowly over time, they got rid of 40 years. Then there was 35 years. Then they got rid of 35 years. Then they got rid of 30 years. And then it was just 25 years for the CMHC people. And then the 20% down people is 30 years. And they also implemented the qualifying rate. So you used to be able to qualify at a mortgage based on what the interest rate was. So if your interest rate is 2.5% and your payment is $1,200, you qualify based on that. So they implemented something called the qualifying rate, which was they added 2% to that interest rate. So if you're paying 2.5%, you still have to qualify on a payment that's based on 4.5%. So you're qualifying. If your payment is $1,200, you're qualifying for a say $1,500 payment, which makes it harder. So at the beginning, not at the beginning, but 15 years ago, before all this happened, you'd see people that were one single income making $60,000, and you'd say to them, "Yeah, you're golden. You can buy a 2-car garage, 4-bedroom house in Oak Ridge, and you're good to go." Now, you need significantly more income to be able to get that. And the prices, it used to be those houses were $300,000, and now they're $800,000. So, and it's really just been along the way all these people that have flooded the market, and we're just not building enough homes and bringing a million people in every year is just exacerbated the problem, and it's created this lack of supply and a huge demand because everybody wants to buy a house, and that's just,
so then from your perspective, is the stress test a bonus? Is it a positive?
The stress test is a positive to a certain extent.
We should probably explain what that is.
Yeah, so with the stress test now, it's your rate plus you qualify at your 2% over what your interest rate is. So you're qualifying for a bigger payment. But the stress test does help kind of tamp down the market right now. However, the issue is today with rates being at the peak. Do we still need the stress test? Our rate's going to go 2%. The question is, our rate's going to go 2% higher again? So if you're qualifying for, I'll use the highest interest-bearing product you can have. Yeah. So if you have a secured line of credit and your rate is prime plus 1, prime is 7.2, so now your rate is 8.2, which sounds crazy, but you're qualifying at 10.2 because your rate is 8.2. So do people really need to qualify at 10.2% for a secured line of credit? It just that destroys the buying power when 2 years ago you were qualifying at 5.25%.
And that's why when the interest rates are high, we see prices are a bit lower, and that's why sometimes it's better to get out when they're higher so that you can lock in at a lower price because the interest rate will change.
Yes.
But your buying power is just more.
It's always good to buy when the market is a little bit quieter or lower, like right now, and rates are maybe a little bit higher because, as I said, you could do that 3-year term, and then 3 years from now, just hopefully we see interest rates be a bit lower than where they are right now, and your payment will go down.
And I think it is like a population thing because they were I know they were talking about trying to fill baby boomer population and let people come into the country more, and I think it's just we got so flooded with people that we weren't prepared for the infrastructure for it, and now
Well, we're bringing 1 million people in and building 100,000 homes. That just doesn't, those numbers don't, I'm no economist.
Yeah, I think they said that
that's not enough.
2.5 million behind, right?
Even if there's 4 people in every home, that's not enough.
Well, it's interesting to look at it too, because we're in London. We're speaking from London terms, but you look at Toronto, you look at Victoria, you look at, and there is a lot more room for us to grow. We're not even in.
Of course, but when you look at Canadian growth year over year, it hasn't been 1 million people a year.
No.
But when you it starts growing that much, you're right. Nothing will allow for that kind of growth. It can be detrimental to a lot of services.
Yeah. And I think it is happening, everywhere. Not that we focus on here, but I think it is happening across the world.
It's happening.
Sure, it is.
It's just
people are
Canada's one of the highest
into
places now.
Into those kind of first world democratic countries, right? So.
And I didn't know if if you wanted to have a recap on what rules that the government has in place, because for example, foreign home buyers,
there's a ban.
There's a ban still.
That's all you need to know.
Yeah, there's a ban. Do we know how long that's going to last though? Because I wonder when they lift it.
Yeah, I off the top of my head, I'm not sure. I know it's around for another year at least.
Okay.
And I would say they probably will extend it because. There's
a challenge that they need to keep that in place. I agree.
Yeah, and it's everything is somewhat political, and so they'll probably keep it.
Nobody knows what the future holds, but we look at stats and trends, and we try to guide you in the best way possible.
It's always predictions, but
but we need to build. The bottom line is we need to build more homes. That's what has to happen because there's not enough homes for the number of people we have, and when your population is growing, 100,000 homes a year is not enough.
Well, we just see it too. I see from living here. Like you guys have been here long before, it's just the growth. I can't get down the street.
I know London is still a fantastic place to live and work and play. I mean, we get a lot of people that live in London but commute to work because London is a great place to raise your family, to own real estate. So we're finding that it could still be that halfway point between London and Sarnia and London and Kitchener. So we still have a lot of people commuting from London, working elsewhere.
Yeah.
In your opinion, Nathan, what's the most important thing, not just for first-time buyers, but anybody looking to renew a mortgage? What is the most important thing that they need to do to prepare before they come and see you?
So if you're looking to renew a mortgage anytime this year or the next couple of years, you have to get started early. So that's
What does that mean? What do you mean by that, Neil? How early?
Yeah. So we can guarantee interest rates or hold interest rates for 4 months. So 4 months before your mortgage renews, we can get an application in and approved, and your rate is guaranteed. And if rates go down in those 4 months, then you'll get the benefit of that lower rate. But I'd say even earlier than that, so 6 months out, 8 months out, it doesn't hurt to have a conversation with someone like me or just me, and talk, because there's going to be some payment shock probably if you're coming off of a 1.7, definitely if you're coming off of a 1.7% fixed rate, or there's a lot of 2s and 3s out there. There's going to be some shock to the payment. There are things we can do, like lengthening your amortization, refinancing, looking at if there's debt, looking at paying off debt and things like that. So there are things we can do, but better to start early, and then when it comes time to apply at that 4-month mark, we at least have a plan, and we know what you need to do if like I said, at that 8-month or 9-month window, you had I noticed a collection on your credit bureau or something like that. We can get that cleaned up so that when we go to apply, it's not an issue and it's not a thorn in our side at the time of application.
Good. I never thought of that, but getting that credit bureau addressed so people are aware of what they're what's in front of them.
Or getting those finer details like your income, like you want to make sure that you have guaranteed hours at work. If you don't have if you haven't been at your job for more than 2 years, you got to have some sort of guaranteed hours to be able to use the income. So those kind of things you want to, I know obviously if your employer's not going to give you the guaranteed hours, that's hard, but at least know to ask the question and make sure that you can get yourself sort of mortgage ready, right? Or mortgage proofed.
Okay.
And if you don't, then that means you have a lack of options, because now you're stuck with your current lender and whatever they are offering you at renewal, which sometimes can be good, but sometimes not. Sometimes they tell you they want to get rid of you by offering you a not so great renewal, right? As kind of a way.
Well, and I'm assuming it never hurts to arm yourself with some comparable.
Yeah, and then you have options,
lenders.
and at the very least, keep your current lender honest, right? At the very
Right.
least, you're going to know what's out there, and keep them honest. And when your lender, most of the mortgage lenders, the banks especially, are very good at offering you the early renewal. So some of them can do 6 months early, renew now. Don't do that, because if you're in 2.5%, you don't want to go into 5% early,
Okay.
right? Just
Okay,
common
yes.
sense. But
Good.
they make it
Yeah.
seem like, oh, we can early renew. This is a great thing. Well, no, it maybe isn't a great thing. So
Yeah, take it to the last.
take it to the
Payment.
last day. On the flip side of that, if you go into like a 3-year term, maybe at 5%, the early renewal 6 months early, so really only 2.5 years from now, might be a good thing, because you want to get out of that 5% sooner and into whatever
yes,
renew rate. So maybe at the end of that, but at this renewal cycle, like right now, this year and probably next year, you want to hang on to that for as long as possible.
Okay, amazing. So I think that I'm just not sure where we're at for time. I'm sure we could talk about mortgaging forever. I wanted to talk a little bit about investing so is there any kind of, if somebody was looking for a rental property, Nathan, and they wanted to invest, or maybe even a first-time home buyer, I thought it might be good to talk about what options they have. For example, we could have a first-time home buyer that could rent out part of their place.
Do the owner occupied thing.
Yeah. So I think if you could share with us just some ways that like you finagle mortgages for people in certain situations, that's your.
So just some ideas on, instead of just most people's way of thinking is
this is your
single
mortgage,
family. Single family home. That's what I'm looking for. But knowing options out there that are maybe a multifamily is right for you, and you live in a little bit of it, collect income, and use that as an equity build for something else.
Yeah. So you can purchase something with as little as 5 or 10% down, up to 4 units. So a duplex 5% down, a triplex or fourplex you need 10% down. But you can use that income in that other unit or those other 2 or 3 units to help you qualify for the mortgage that you're looking for. So that income is usable. A lot of times people have houses they're buying that are granny suites. And you can look
That's
as long as the granny
people,
suite has like a separate entrance and is a legal
and that's a requirement, separate
secondary
entrance,
unit.
right?
You gotta have a second entrance that's completely separate. Then you can use that income from that granny suite. So and then what happens is we'd have an appraiser go out and he would evaluate that basement unit or that second unit if it was a duplex or more, and tell us this is what that place it's going to rent for $1,200, and then we can use that number and help you qualify for more.
And thank you. I really wanted to kind of mention that because especially with, first-time home buyers, we understand it's not as easy as it was. That's what we're talking about. The market has changed so much, but there's options for you. And if not a one-size-fits-all, you might be able to own and rent out a piece of your property or even purchase with a friend. Yeah. And then you have lawyers and mortgage agents and everyone to make sure you're protected if that's...
And then you could, I just thought of that announcement of last week with the 30-year AM. So you could buy, in theory, a purpose-built duplex or triplex for under $1 million with 5%
That's a great
down,
idea.
and you get the 30-year amortization plus the rental income. So it's something to think about.
I mean, it's nice that you can kind of group a bunch of those together in a situation like that.
Yeah, you got to find them. Like I don't know that there's a ton of those new build duplex and triplexes in London right now, but they're they're around. And home builders are doing. I know there's. Some home builders in London that are building like granny suite, like they're kind of with the granny suite in mind, they're starting to do that. So that those things will come into play more, I think. And I think also as people are realizing you maybe you have a multi-generational family that's, if you can get mom and dad to live in the basement and that helps you qualify for the mortgage. So they're building things that are kind of to a certain extent purpose built for that.
Yeah.
So,
would it be possible if, say, multi-generational family wanted to purchase something, would it be possible to buy a home and renovate it to your specifications with mortgage money?
You can do that, yeah. So you can buy a home and with, again, as little as 5% down, 10% down.
Hilarious.
And you can do, CMHC has a purchase plus improvements program, so
Purchase
you can
plus.
you can do typically 10%
Trying to
of
get
the
my
purchase.
team members to-
Typically 10% of the purchase price is the max.
Okay.
But not all the time, and sometimes they'll do multiple draws. So if you're doing like a major renovation, like I've seen some lenders where they're doing like $80,000, $100,000 renos, a couple of draws. It didn't used to be that way. It used to be like a hard cap at like $40,000 and one draw only. But now they've kind of opened it up a little bit more. So it's kind of case by case with those ones.
And case by case meaning, what if somebody wanted to do renovations because of health issues? They needed grab bars, they needed wider doorways, they needed ramps, that type of thing.
Wheel-in showers,
Yes.
up.
Does
You could do
that
yes.
qualify?
You could yes. That would qualify. Anything like that would qualify. Yeah.
Okay.
Yeah. So and it depends if they're doing that. They're probably more than 20%. They probably have more than 20% equity, and then they could do. There are other options then, right? Too. So with those are the caps are on the less than 20% the CMHC mortgages. But if you have an existing home and you need to do renovations like that, then that's no problem as long as you got the equity in there. So.
Yeah.
Great.
So we're being told to wrap it up. Nathan, we'd love you to come back and
Bring lunch
discuss
next time.
some
Yeah.
of this.
Yeah, I will.
There's so
Somebody eat.
much of this that we can dive into.
Discuss.
But yeah, this is just, we're trying to kind of, skim the surface of this and just let people know there are options out there for lending. It's not always just about what you hear on the news about the posted rates and stuff. We want to make sure you're discussing it with somebody that can show you the best product for you, and it's not always just about interest rate. It could be multiple options for you that can benefit you during your purchase process. So we just want everybody to be aware of that. So of course, anything that you think of, there's no question too big, no question too small. Reach out anytime. We're always around to help out.
And just a reminder as well, in case you missed our last episode, the First Time Homebuyer podcast is now up and available, featuring our special guest today, Nathan Degiorgio.
But
and George.
and it's not just first time; it's any buy.
Anybody.
We want
I
everybody to witness that
apologize.
one.
But the reason why I'm mentioning it is because we do have the podcast episode up that is just the
It's a good
audio. If you are interested in the entire presentation, there is a form on our homepage. Just fill that out and we would be happy to send that to you. We only have the audio for public use right now. And of course, if you'd like to meet with one of us in person and talk further about it, that's what we're here for.
Always around. Okay, thanks
Thank
for
you.
tuning in, everybody.
Okay, thanks for having me,
Until
guys.
next time.
Thanks.